Thank you for watching. In this episode, we're going to discuss interest rates. Interest rates recently just went up, so we're going to be here again with Brad Malkin, who is the owner and principal of Noble Home Loans. And he's going to explain to us a little bit more about interest rates and how and why we've gotten to this point. So first off, can you explain to us what exactly it means when the Fed is going to meet and they're supposed to have a Fed rate hike? What does that actually mean in correlation to mortgage interest rates?
Well, it doesn't really correlate to mortgage rates. The Fed is going to raise their discount rate, which is the cost that banks have to borrow money from the Fed at. That's on a very short end of the rate curve. You have to think of the rate curve as starting at zero timeline and then going out to 30 years, okay? And then a normal curve is going to have the fixed rate, the longer term fixed rates should be at a higher rate than that, which is the reason why the overnight rates are so low. And you'll see that as you go through the curve that the 2 years are higher and the 5 years are higher and so forth till you get to the 30-year rates, and those are typically the highest. Well, the Fed only has ability to manipulate the very short end because that's where the rates start with. It's their discount rate that starts everything. So it's going to affect credit card rates. It's going to affect home equity lines of credit. It's going to affect auto loan rates. But it's not really going to affect mortgage rates because those trade more off of the 10-year than the 10-year Treasury note than they do off of anything else. So a Fed rate hike is likely not going to have any real correlation to mortgage interest rates. Now, the other thing to keep in mind is that rates trade based on supply and demand. And so while economic data is extremely important, and I wouldn't push it to the side, at the end of the day, it's really about supply and demand. And when people have an expectation that economies are going to improve, money would rather flow into stocks. It's a growth scenario. And because of that, money flows out of bonds and they want to be in higher yielding type asset classes. When that happens is the supply of bonds is fairly fixed, the demand goes down, and people have to sell. If you want to sell a bond when there is more supply than demand, you're going to sell it at a discount. The rate and price relationship on bonds is inverted so that the lower the price of the bond, the higher the interest rate is going to be. And right now we're just trying to find that equilibrium where that's going to end up.
So now, speaking of economies, what effect does what's going on in Europe and potentially other countries, does that have any effect on our interest rates or the Fed's or anything having to do with that system?
Yes, across the board. So what happens is that we're in a global economy today. It's no longer, we don't have walls around us, or at least not yet. At the end of the day, what happens in Europe very much affects the U.S. What happens in the U.S. very much affects Europe. What happens in the Far East affects everybody. And so when the European economy is not growing, goods that we supply to Europe, U.S. companies that provide goods to Europe aren't being purchased. Effectively, what happens is that it hurts everyone. And when that economy will grow, a rising tide lifts all boats. Going back to the Fed rate hike for a moment, the concern and what happened last year when the Fed raised rates in December of 2015 is the higher borrowing costs equate to potentially lower corporate earnings. If companies have lower earnings, people don't want to invest money into the stock market.
Right.
Money flowed into bonds. Because of that, rates actually improved when the Fed raised rates last year.
So what you're saying is just because the Fed raises rates, that doesn't necessarily insinuate that mortgage interest rates are going to go up either.
Right. I mean, so the bond traders tend to be the smartest guys at the table. And so what happens is that nobody's waiting for the Fed to say, okay, we're raising rates to then change their investment pool, to change their policies, and so forth. That Fed rate hike coming next week is already priced into the market. So it's really going to be the commentary that comes from the Fed that is what the markets are going to digest, because that's the one thing that they don't expect, right? I mean, there's currently 100% certainty within the market that the Fed is going to raise next week.
Okay. And so to wrap this up, I mean, the million-dollar question that everyone wants to know is, going into next year, where do you see interest rates going? I mean, is it too early to predict with so much uncertainty with the president-elect? Where do you see rates going next year?
Right. If I were getting a loan and I could wait to lock in the loan, I probably would wait a little bit, because I think that rates are going to retrace about half of the losses that they've taken. So if the market's up half of a point right now, I would say that, it wouldn't surprise me at the end of January that we're looking at a quarter point better than where we are right now. So we may lose about half. We may have lost about a quarter of a point at the end of it. The Trump policies are going to be hopefully very growth centric and help the market, but they also take a long time to implement, and we're not going to see the results of those for 2 quarters. I mean, we're not really going to see GDP grow. We're not going to see those real numbers correlate back to his policies for a while. So I think that there's a window there that the rates are going to improve. But I also think that depending on what Mr. Trump's policies become as we learn them, if they're inflationary, it's going to drive rates higher quicker.
Wonderful. Well, there you have it. There will be ebbs and there will be flows in the future, not necessarily a linear path upward or downward. Well, thank you for watching. Please subscribe, and we'll have more videos coming your way soon.